The loan officer training with the mortgage calculator. Tonight, we're going to be talking about how to dispute an appraisal valuation and remain compliant, most importantly, while doing so. Give us just a minute here to go live on all the platforms. We put the chat up on the screen. Go ahead and drop a comment there in the chat as you tune in, and we'll get started in just a moment. You can also drop any questions you have as we go through the training here today in the chat, and I'm sure Jose will be happy to answer them. All right, it looks like we are live, so we will go ahead and get it started. We'll take the chat off the screen for now, but go ahead and keep dropping comments there in the chat. All right. Welcome, everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender, and every Tuesday and Wednesday evening at 7 p.m. Eastern, we do our loan officer training series where we do a new loan officer training topic. Tonight, we're going to be talking about how to dispute an appraisal and remain compliant while doing so. Jose, our sales manager with 28 years of experience, has seen his fair share of, I think, people butchering this process, right, Jose? And also your fair share of probably frustration with your own appraisals coming back, not how you want them and going to war. There you go. Exactly. All right. So there you go, Jose. I'll let you take it away from here.
All right. Good evening, everybody. This is a great one tonight. As most of you know, I've been a real estate agent as well as a mortgage loan originator for 28 years. So I'm giving a little insight from multiple fronts here. So that obviously puts me and all others that are real estate agents out there, at least on a local level. If you're a member of your board, you have a little bit of extra access to data. And on a national level as well, with RPR, Realtor Property Resource, you have another access to data. So for those of our licensed MLOs out there that are also licensed real estate agents, hey, don't forget RPR, right? That's the database, the national database. With that being said, tonight's show is very important because, as you know, we're getting constant pressure on valuations, right? We are still seeing upward movements in the prices in the properties, but as you know, the closed sales don't always keep up with the current market, and sometimes that presents us with challenges, right? Somebody really wanted that property, they put in the offer. Now you have an appraisal valuation issue, right? Or on a refi, whether it's a cash out or a rate and term, maybe you have the borrowers coming in with certain expectations on what their property's worth, right? Their neighbors across the street, same house, just sold for X dollar amount, or another neighbor next to them just refinanced theirs, same model, and they got X valuation, and now you're doing the deal. And they have certain expectations that are already met. Now, I usually like to empower my borrowers and let them, give them some upfront data as to what we think the valuation is, whether it's a purchase or whether it's a refi. Obviously, I'm not going to try to discourage any situation from occurring, because remember, I am not a licensed appraiser, right? So only a licensed appraiser can give you the true appraised value of the property. I can look for what other people do, comps, or you as an MLO can have a licensed realtor provide you comps. But in the end, we all have to remember, we're not the appraiser. We can't profess to be the appraiser. We can only give some suggestions on what the value will be. So always keeping in context and letting the borrower know that, it's subject to the appraisal, we're not the appraiser, and, set the expectations. So let me share with you our title for today, which is How to Maintain Compliance and Dispute an Appraisal Valuation, right? That's really important, especially when we consider the compliance part, because the first part of tonight's presentation is really going to revolve around compliance with appraisal independence. That's really important. I remember we had a deal a couple years ago when we were at the bank, and our borrower, who owned like half of the town there, prominent individual, and apparently while the appraiser, and now this is borrower violating it, right? We're not even talking MLO here. While the appraiser was on the site doing whatever they were doing there, the borrower was, I guess, pressuring the appraiser. I'm not going to really say harassing him, but I'm sure he was pressuring the appraiser about the valuation and a bunch of different aspects of the appraisal, to the point that the appraiser turned around, got upset, told him he didn't appreciate all of the pressure, quote unquote, and turned around and walked away, canceled the appraisal. And the reason he gave was the behavior by the borrower. And it took like a month to get that appraiser out there. It was like this remote island, I think, in the North Carolina area. And he was like the only person. So that sort of really affected that deal. So you can have an idea of the importance of trying to maintain your compliance in all of your actions and in your institution's actions. And also, if you're for those borrowers that are out there, in the borrowers' actions and the realtors as well. I mean, this has to do with all parties involved in the transaction, not just the mortgage loan originator, right? We all work as a team. So let's get a little bit into the compliance portion of it. And what we're really referring to here is appraiser independence requirements. Now, I have a sample there of an appraiser independence certification, also known as an AIR, capital A, capital I, capital R certification, which is appraiser independence requirements certification, right? And that's a requirement on all your appraisals. You are to receive that certification, and you will usually be required by underwriting to provide that certification as part of the supporting documentations of an appraisal. You have the AIR certification, you have the delivery certification that the borrower received that appraisal. I think it's within 3 days, right? Those are two important documents, along with like your XML and your invoice and your actual PDF, right? Now, the XML they use to verify that the appraisal hasn't been doctored, because with that XML, they're going to recreate the same appraisal, right? And hopefully there are not any discrepancies between the one that you turned in and the XML appraisal that they generate. And then you have also the SSRs, right? Fannie Mae and Freddie Mac SSRs, that are the forms that measure the risk in the appraisal, right? So the lower the number, the better. Usually 2.5 or below is preferred. To above 2.5, you may be asked for some type of an AVM or a CDA, or in some cases, even a second appraisal. So be aware of those items. Now, the AIR certification, which is the one that we're really concerned with right now, uh, really is it's a code of ethics for appraisers, and how they're supposed to act, and how they are not to be treated, right? And some of the points, which you can't read unless you have a big screen like I have right now. Some of them, like point number one, says withholding or threatening to withhold timely payment or partial payment for any appraisal report. Now, these are some of the prohibited items, right? Withholding or threatening to withhold future business with me, or demoting or terminating or threatening to demote or terminate me, if you don't like the appraisal, obviously. Expressly or impliedly promising future business promotions or increased compensation for the appraiser if you like their work. And you can go down the list. But And I also recommend that you all go into, for example, the Fannie Mae. Fannie Mae actually has this as one of their requirements. So you can see the actual 4-page document. Fannie Mae has a 4-page document on appraiser independence requirements, right? And I'm only going to touch on a couple of the main points here, but the Fannie Mae appraiser independent requirements are used to set forth standards to safeguard the independence, objectivity, and impartiality of appraisers and independent parties to the transaction. And I stress independent parties to the transaction because that's where we come in as loan officers. That's where you're looking at the borrower, the seller, the real estate agent, the title company, insurance agent, any of these people that are going to make money on the transaction have to really be careful of their actions around the appraiser. Because as bullet point 2, the second bullet point states, no person is allowed to influence or attempt to influence the development, reporting, result, or review of an appraisal through coercion, extortion, collusion, compensation, inducement, intimidation, bribery, or any other manner. I was running out of fingers after that, already at 8 there, right? So, in Fannie Mae's 4-page document of appraiser independence requirements, they really break it down and let you know what you can do and what you can't do. So, I really recommend all of you that aren't aware of that document, just you can Google and do a quick search, a minute search engine there, and you'll find it in 3 seconds. Now, under federal law, now I'm going to give you some of the things you can do, right? Pretty limited, but you can expand that in your mind, but it's pretty straightforward. Under federal law, a financial institution's loan production staff may ask an appraiser to undertake one or more of the following. Now, pay attention. Consider additional appropriate property information, including the consideration of additional comparable properties, right? So obviously, if now there's some guidelines I'm going to give you for that in a minute, but this is what you can do. So one thing is just you think there's more comps or better comps, should I really say, than the ones that they selected. You feel free to let the appraiser know, but you're not going to go directly to the appraiser that did the report. That would be a direct violation of the appraiser independence requirements, right? You're going to go to the AMC, the appraisal management company, and you're going to present that to them through whichever form they specifically have. This process called the reconsideration of value. That's what we're going to touch on in this presentation. So that's one of the things you can provide your reconsideration of value form, and in that reconsideration of value form, you can provide additional, more relevant, comparable sales that fall within the time frame of the appraisal. You can provide further detail, substantiation, or explanation for the appraiser's value conclusion. Not your value conclusion. Notice what it states there, for the appraiser's value conclusion. In other words, if you think that the appraiser may have missed something, right? Like I just have a listing on the contract. It's a nice fancy property, and this owner put like $400,000 in upgrades, and some of the things are things you can't see, like it's a totally smart house. Everything there, he can control it on an app on his cell phone. Open and close the garage doors for the delivery guy comes. He can let him in. Hey, okay, put it in my garage and close it. Open and close every door. Turn off the ACs. Turn on the ACs. Turn off the sprinklers. Turn on the sprinklers. Turn all the lights on and off. Turn the pool on, off the pool lights. I mean, every gadget that's in the home, TVs and everything, and volumes. Every gadget can be controlled on the app on the phone, right? Spend a lot of money doing that. Obviously, if you're an appraiser, you go and you're just taking photos, you're just looking at the home. But now, if somebody provides the appraiser with the documentation, look, this is what was done, yada yada. You're giving extra further details so they can do their job because they're not mind readers and they're always in a hurry. But if you prepare properly in what you are allowed to do within the constraints of the law, hey, by all means, just do your job properly, but in a manner of just uh, empowering the appraiser is what you're doing, right? And then the third bullet point, this is one of the ones where your loan processors can help you, right? The loan processor can't help you in bullet point number one or bullet point number two, but your loan processor can certainly help you in correcting errors in the appraisal report. Errors, we're talking like the name is wrong, the loan number is wrong, property address is wrong, or any other typo that you see in the report, especially ones that you think could affect value. Like, hey, I'm looking at this here and you did your math wrong. That does happen, believe it or not. You can find it. An adjustment was not put that was should have been put. They adjusted some other comparables that didn't adjust one, and with the adjustment, it helps your value. That happens. That happened to me actually on one deal with a garage where the subject property had a one car garage. It was a townhouse, and the other properties did not. And there was no adjustment for the garage, even though the garage, I believe, was a $5,000 adjustment. And when the adjustments were made, it was a increased the property by the value that we needed. So just little things like that that you can pick up and you can bring to their attention. So uh, now this is the AIR requirements, right? The certification. That's the points that you have to consider when approaching the AMC, right? You don't want to be sending out these crazy emails about the terrible job that they're doing and making it seem like you're going to cancel the account or get the account canceled unless this is taken care of. That's a total violation of this act, and you're going to get yourself in trouble. Everything has to be done in a professional manner, making sure that you don't send the kind of emails that are going to get you in trouble. And I only say that because I've seen them go out. I've seen them go out, and we've had to, tone them down a little bit, the MLOs on those. So now there's a vehicle that we use to do this, which is the reconsideration of value form. Now that's a generic one there, but they all pretty much look very similar in what they ask. Now, I mentioned first and foremost, take into consideration the appraisal independence requirements and how you have to act. Go into the Fannie Mae document, the 4-page document, and review it and make sure that you're not going to be acting like any of those unallowed actions that will get you in trouble. And then request the reconsideration of value form from the AMC that the appraisal was ordered from, right? Because each one is going to have their specific form with specific contact information. The instructions may change a little bit, but all is pretty much going to be in the gist of what I'm giving you here. Now, in a reconsideration of value form, and with every AMC that I've seen out there, they limit one appraisal dispute per report, meaning you cannot dispute the same appraisal twice. You put it in, and you better do a good solid job, be thorough and precise with what you present, because if they turn it down, you're not going to get a second chance to dispute the same appraisal. And you can't say, well, you know what, I'm going to cancel this one, I'm going to order another appraisal from another company, because then that's just going to open up a whole other can of worms. The only way that would ever be allowed to be done is if it was proven beyond any reasonable doubts that the first appraisal was totally just bad, messed up, incorrect. Cannot, I mean, it was like it's a 4-unit property and they did an appraisal for a 1-unit property, different things like that are just this, it's totally incorrect, right? So at some point, then you would need a new appraisal. Let's do one for a 4-unit because that one was done for a 1-unit, or it was the wrong form, right? stuff like that. So you should have ordered a 1025, but you ordered a 1004, right? But you can't say that appraisal is no good. I'm just going to order another one. Doesn't work that way. So limit to one appraisal dispute per report. Limit of 4 quality, stressing quality now, alternative sales. Do not reference a final dollar amount of market value or a range of values desired, because that's going to seem like you're almost coercing them to hit that target or else. Now, if it's a sale, yes, there's going to ask you in the order, what's the sales price? And you're going to upload the contract. But if it's a refi, you're not going to say, hey, I'm refinancing this and we have an estimated value of $280,000 or whatever it may be, because you just violated this whole rule, and they may not even take the order and tell you, hey, we can't take this order like this. It's tainted with your evaluation. Provide verifiable sales and sources. The preferred verifiable sales source on these is the multiple listing service, the MLS. Appraisers will always use sales in the MLS unless there are no other sales, and then you'd have to have a HUD-1 or a closing statement, and you know how hard it is to get those, because if you see a sale in public records, like in the tax roll, and you want to use that sale as a comparable sale, then you better be able to obtain a copy of the closing statement for that sale, because we know a lot of times that public records can be wrong, or we need to know the more details on the transaction. In the MLS, it says if there's seller contribution, the amount of the seller contribution, because appraisers make those kind of adjustments, but public record sales don't have any breakdown of anything other than a price. So, and it has no photos, and doesn't talk about property condition, if it was totally remodeled or not, or if it was terrible condition, or it's just says very basic data. So almost always the preferred verifiable sales source is the MLS. Now, avoid these common pitfalls, right? In other words, first, don't provide any comps that are already on the report, because then you've just eliminated one of the comps. And if they're asking for 4, and now one of the 4 you provided is one that's already on the appraisal report, you've just dashed your reconsideration of value. Do not provide comps with larger square footage differences than those utilized by the appraiser. Now, what does that mean? That means that if the appraiser used comps in the range of, let's say your subject property is 1,500 square feet, and the appraiser used comps in the range of 14 to 1,700 square feet, to say an example, and now you're trying to provide comps that are, 2,000 square feet with the assumption that, well, you can adjust down, or comps that are 1,200 square feet with the assumption, oh, you can adjust up. Well, those are going to be bigger adjustments than what the appraiser has already included on the report. And what would be the reason now to use one of those comps, right? That has such a difference in square footage, if there were suitable comps with closer GLA, as they like to call it, gross living area, to the subject, it's not going to make sense. It's going to look like you're trying to force the issue with some fancy math by doing all these adjustments, and the less adjustments you have, the better the appraisal is. Do not provide comps that are closed after the effective date of the appraisal. So what does that mean? Okay, they gave you your appraisal report dated effective date of February 29th. That's the date the appraiser signed off on the report. And now you some of your closed sales that you have show closed on March 3rd. Great comp, amazing model match, like they like to call it in the industry. That means it's the same exact house, probably in the same subdivision, very close proximity, but it closed on March 3rd, and your appraisal effective date was February 29th. So guess what? You can't use that comp. You got to use ones that close before the effective date of the appraisal. And then obviously you're going to be limiting yourself now by, the date. You got to have some comps that are no more than 3 months, some that are no more than 6 months. You definitely don't want to just have all your comps be like more than 6 months, and in some cases more than 12 months, and have no recent comps unless there weren't any, right? And then the appraiser has to explain that, right? That's always what it's going to boil down to. If the appraiser, and in some cases that's really what you need them to do, but uh, if the appraiser wasn't able to find any recent comps, then they're going to state there were no recent comps. These are the ones I found. And then in that case, if you find a comp in a similar neighborhood but a little further away, that's where you can possibly get that comp, because there were no comps in the last 3 months that were in close proximity to the subject. So we were able to find some comps that were a little further away, because time really does make a difference, unless the appraiser felt like they compensated for the 12-month-old comps by adjusting the value. But in a hot market, we all know that's tough to gauge properly. So the best way hopefully to deal with that is that you'd be able to find some model match but a little further away, and it was a recent sale, and then pose your solid argument. Because if you look at the form, notice that the form asks the source, right, or the MLS ID, really what they prefer, the source, the sold date, the address, then you have the number of bedrooms, number of bath, GLA, which is gross living area, distance, which means distance from the subject, and then your comments. That's the part I'm talking about, where you come in as a consultant, and not to say I think this is worth X dollar amount or anything like that, because they're gonna right then and there disqualifies your reconsideration of value. But that's where you're gonna state your rebuttal as to why you feel this is a good comp, not a better comp than the ones they picked already. Why you think it's a good comp. And the reason is, this is a great comp because this is a model match to the subject with very similar bedroom and bath count. This model also has a one-car carport like the subject. Uh, it, and it's a very recent sale, but due to lack of sales in close proximity to the subject, this is the closest one that I was able to find that sold within the last 3 months, right? Something like that. Because remember, we're going to have a lot more time to look for these comps, and your realtor partners as well, than the appraiser is going to spend looking for the comps. So, but if you find a good one, hey, they're going to include it, but just don't make it seem like they didn't do their job right. Don't make it into that kind of a battle. Make it into a positive experience for everybody involved, and that's why the comments section right here are critical, and what you put in there could make it or break it. And then we get to the last bullet point, which fits right into here. Another common pitfall: providing comps outside of the subject's market area, or comps further in distance than those already utilized, as the appraiser cannot overlook homes in the immediate market and will only look in similar markets, in other words, the one that's maybe 2 miles or 3 miles away, when none are available within, right? So that's so important, because that and you see these common pitfalls that we're talking about here. This is very important for you to understand these, because when you reach out to your realtor partners out there, those of you that aren't licensed realtors, or those of you that are reaching out in areas where you don't have access to the data, that happens quite a bit. We're looking for comps, and that local board doesn't share the data feed. So you have no way to get the access to the data unless you reach out to a local professional. But realtors are how realtors will be, and realtors have a certain way of analyzing value. They're used to doing comparable market analysis for the purpose of getting a listing, talking to a prospective seller, pumping them up about their property. And sometimes, they're not looking at the same way you're looking at it when you're trying to obtain comps for a reconsideration of value. It's a different situation. So this is why when you understand these common pitfalls, you work together with the real estate agent who you're looking to partner with to help you with this, and you work together to make sure they give you the best comps. And you're gonna let the realtors know, I need comps with similar square footage unless there's none available. And then you gotta let me know there's none available and let me know which are the closest ones you found, right? And the comps with the largest square footage and the comps outside the subject. That's where sometimes I see realtors provide comps to loan officers, and they're like, you know, 1,400 square foot bigger, and they all think, well, yeah, we're just going to adjust it. No, it doesn't work that way. On top of that, there's percentage differences on the adjustment that you can make anyhow. Um, but the whole point of this part here is work collaborating with the realtors so that you can get the best comps. And that's a really good thing because you're going to be working closely with this realtor. Hopefully, then you're going to get referrals. You're going to give them referrals, right? Which is what I talk about here in our last slides: recommendations for a successful reconsideration of value. So we talked about compliance, right? So we talked about how the ethics involved and the buttons that you can't press, right? That was our first slide. And we talked about how to complete the reconsideration of value form successfully. But what I want to talk about here is the recommendation. Well, actually, the second was how to complete the form. But now here are recommendations for a successful reconsideration of value. And the first bullet point I have here, I very proudly state: reach out to a local real estate agent or the borrower's agent. If it's a purchase, they have an agent already, right? If it's a refi, maybe they have the information on the agent who they use to buy the property, or they know an agent that they can recommend who they've talked to locally, and then you can reach out to the agent, explain to them what you need, and also explain to them how you pre-approve buyers all the time for their area and how you would love to be able to refer these pre-approved buyers to them, right? No referral fee ever is going to have to be paid. You are doing a professional referral so that then they can obviously remember you and refer you the loans to these pre-approved buyers that you give them, plus all these other buyers that they have, plus the other agents in their office where they're going to say, Jose is really on top of things, and I really think you should use him because he has great DSCR loans and rates and all that good stuff. So you can just imagine how this can help you build business. But first and foremost, then, is going to help you complete your reconsideration of value. So reach out to the local real estate agent, or and request comps. Like I mentioned in the previous slide, work closely with them to ensure the quality of the comps. Remember the bullet points I mentioned on what is important. Again, great opportunity to establish the business relationship, refer them pre-approved buyers, receive referrals. Because remember, you have to give to receive. Real important. Now, and my final recommendation, summarizing what we covered in the other slide, and some nice solid bullet points here. Obtain comps that are closest in proximity to the subject. That's an obvious, but I want to stress how important it is. Only if there aren't any comps in close proximity to the subject recently sold would you be able to use other ones, and then they would have to be properly explained by the appraiser to be acceptable. Obtain only comps that are similar in gross living area, also known as GLA, to the subject. Obtain comps that are similar in bedroom and bath count to the subject. Similar in design and style to the subject. That's a real important one now because, for example, if you have a newer home, and I'm going to use, usually it's the other way around, but let's say your comp is, or let's use this one. Let's say your comp is an older home built in the 40s or the 50s, right? When closets were small, kitchens were small, everything was small. I guess people had less clothes and stuff like that. And now you're trying to compare that home to a home brand new construction built a year ago, maybe close proximity to the subject, but it's definitely not similar design and style because this home has a two-car garage. This home has a huge family room, living room, kitchen combination, an amazing huge kitchen, a covered terrace. Has huge walk-in closets in every bedroom. Even though, and it may even have similar gross living area, but probably not. It's probably going to be bigger. But let's just talk about the design and style. That's going to be a tough one to sell, to have the appraiser include that home, and vice versa. If your home, the subject is a newer home and they're including just a bunch of old homes and not giving you the proper condition adjustments and stuff like that, hopefully there's some other new homes in the area that you can find as comps, even if they sold a little bit further back or they're a little bit further out in proximity. That's a real important attribute, right? So, but again, it's on how you present it in your reconsideration of value. You want to obtain recent comps, so you don't really want to go more than 6 months out unless there's no other options. Because in appraisals, and the standards, they're going to require, depending on also on non-QM, they may have different appraisal guidelines as well, but they're going to want some comps that are at least no more than 3 months old. Then they're going to want the majority to be less than 6 months old, and then anything deviating from that has to be some serious explanations in the appraisal. You also want to obtain comps that have similar options, like a pool, garage, whether it's one or two space garage, a carport, covered terrace, and decks, wood decks. Or adjustments are going to be required. Now, if your home is a pool home and there's no other pool homes in the neighborhood, that's going to be tough. However, if there's a lot of pool homes in the neighborhood, good for you. But keep in mind, obviously there's adjustments. I don't know, $10,000, $15,000 usually for a pool or no pool, and that's where if you find a model match, except for the pool, that is going to come into play too. So that's another way to try to work things out when maybe the appraiser only grabbed pool homes because that was the quickest thing to do. Bop bop bop. They quickly found 3 homes with pools. Those are the ones they grabbed. But hey, you know what? There's 2 other great similar model matches. I mean, exact square footage, almost a clone of the subject, right? But it just doesn't have a pool. That's a great comp that they can just adjust away the value of the pool. So remember, you're going to have a lot more time to look into these comps with your realtor partner than the appraiser is probably going to look for the comps. So just keep that in mind. And last bullet point here is we're talking about similar property condition. So if the subject is not remodeled, don't try to just compare it to 4 remodeled properties. If the appraiser grabbed 4 unremodeled properties, for example, in their report, and you're saying, yeah, but look at this one, this one, this one, this one, they also for 30,000 more, 50,000 more, 60,000 more, 80,000 more. But then you look at them and they all say totally remodeled, new kitchen, new bath, new roof, new windows, new everything, new appliances. And yours is a fixer upper, or let's say not a fixer upper, but it hasn't been remodeled in the last 20 or 25 years, right? It could even have some of those avocado color appliances, right? And you're trying to compare it to totally remodeled homes. That's not going to work either. You're not going to have a successful reconsideration of value. So part of this is common sense. A lot of this is just basic connecting the dots, working diligently, collaborating well with the professionals out there that have access to the data, your real estate agents in those local markets, and it's gonna help you close this sale, and it's also going to help you generate additional new business here. Let me see. Can you guys see the bottom of that one there? No. No. So I was trying to see at the bottom caption there, but I think that last one says similar property condition or adjustment required. So I think with all of this here, yeah, you all have some great guidance on being able to complete a reconsideration of value. Basically, just knowing what a reconsideration of value is. It's the way to get the appraiser to consider additional information and how to do it in a manner that's not going to get you in trouble. Real important here. We don't want any complaints against your license, and definitely don't want any complaints against the company that you have your license with, because everybody gets pulled into the mix if the appraiser feels that they are being coerced into a value.
All right, looks like we do have one question here, and the question is: are comps always used for an? I'm not sure if you mean for just an appraisal or an appraisal reconsideration, but either way, the answer is yes.
Well, yeah, I mean, I think that the scenario where I could see maybe some of that would be if you're looking at the appraisal report and maybe you found some errors, like errors in the adjustments, like the one where all I needed was $5,000, and I was able to find errors in the adjustments. Right, that's where they missed the adjustment on the 1 car garage and 2 car garage versus no garages. That one was more of a narrative reconsideration of value there. But obviously, if the point is that the comps, if everything's correct in the report, and it's just that the comps really may not be the best ones, and then you collaborate with your real estate partners out there, and you find what you consider are better comps. Remember, it's all in the packaging of the reconsideration of value, and when you present it, if you're going to be successful.
All right. Okay. I don't see any other questions. Great training there, Jose. Let's make sure to all be careful there when we need to make that happen. But when you need to roll up your sleeves and get it done, like Jose's done a few times, it's important. So it's important to know how to do it correctly. So with that being said, we'll go ahead and wrap it up. Remember, we do this at 7 p.m. Eastern every Tuesday and Wednesday evening, where we go through a new loan training topic. So we'll be back tomorrow with a new topic. Thank you, everybody, for tuning in. We'll see you tomorrow, Wednesday, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a great night, everyone.
Have a great night.